Understanding leverage ratios, an in-depth guide. Leverage ratios are critical financial metrics that provide insights into the degree of debt that a company, financial institution, or individual carries relative to other financial metrics. They serve as essential tools for evaluating the ability to meet financial obligations and understanding the capital structure of a business. This article delves into the various types of leverage ratios, their implications, and the role they play in the financial landscape. What is a leverage ratio? A leverage ratio is a financial measurement used in finance, business, and economics to assess the level of debt concerning another financial metric. It can serve multiple purposes, such as determining how much of a company's capital comes from debt, loans, and evaluating its capacity to meet financial obligations. The most common leverage ratios include debt-to-equity, D/E ratio, equity multiplier, debt-to-capitalization ratio, degree of financial leverage, DFL, consumer leverage ratio, debt-to-capital ratio, debt-to-EBITDA ratio, debt-to-EBITDAX ratio, interest coverage ratio, fixed charge coverage ratio. Businesses often rely on a mix of equity and debt for financing. Understanding the amount of debt held is crucial in evaluating whether it can cover its obligations as they arise. Key takeaways. 1. Leverage ratios. These ratios help in assessing an entity's ability to meet financial obligations and understand its capital structure. 2. Types of ratios. Various leverage ratios exist, each serving distinct purposes and providing insights into different aspects of financial performance. 3. Risk assessment. Both high and low leverage can raise questions regarding a company's financial health. Finding the right balance is critical. What does a leverage ratio tell you? Leverage ratios primarily measure the ability of a company or individual to meet their financial commitments. High debt levels can present risks, leading to credit downgrades or even bankruptcy if earnings cannot cover interest expenses. On the contrary, low levels of debt might indicate that a company lacks growth opportunities. Factors in leverage ratios. Leverage ratios consider factors such as debt, the total liabilities a company owes; equity, the total shareholders' equity; assets, the total value of resources owned; interest expenses, the cost incurred by borrowing money. Beyond measuring financial health, some ratios, like the consumer leverage ratio, gauge macroeconomic conditions by reflecting the debt load relative to disposable income. The role of leverage in banking. Banks are typically among the most leveraged institutions. The combination of fractional reserve banking practices and regulatory frameworks like the FDIC ensures liquidity and stability, albeit with some risks. Regulatory authorities, namely the FDIC, Federal Reserve, and Office of the Comptroller of the Currency, OCC, govern how much leverage banks can maintain. In light of the financial crises, these regulations have tightened, requiring banks to bolster their capital reserves significantly. This scrutiny has only increased post-2008 financial crisis, making it more challenging for banks to lend. In 2023, after several banking failures, regulators proposed stricter requirements for banks with assets over $100 billion, indicating continued vigilance to safeguard the financial system. Common types of leverage ratios. Understanding the usual leverage ratios provides insights into how they are employed in financial analysis. 1. Debt-to-equity, D/E ratio. The D/E ratio is a key indicator of the relative proportion of shareholders' equity and debt used to finance a company's assets. It is calculated as \text debt-to-equity ratio equals \frac text total liabilities \text total shareholders' equity \. A high D/E ratio, typically above 2.0, can signify a high-risk scenario, particularly in capital-intensive industries. 2. Equity multiplier. This ratio focuses on assets to equity and indicates how much of a company's assets are financed through equity. It is expressed as \text equity multiplier equals \frac text total assets \text total equity \. A higher equity multiplier suggests that a company is using more debt relative to equity. 3. Debt to capitalization ratio. This ratio gives a clear picture of a company's capital structure. \text debt to capitalization equals \frac text total debt \text total debt plus \text total equity \. Higher ratios indicate more financing through debt relative to equity, raising the financial risk. 4. Degree of financial leverage, DFL. DFL measures the sensitivity of a company's earnings per share to changes in its operating income. It is formulated as \DFL equals \frac percent text change in EPS percent text change in EBIT . A higher DFL indicates greater volatility in earnings, which can be risky if operating income declines. 5. Consumer leverage ratio. It represents the level of consumer debt relative to disposable personal income and is calculated as \text consumer leverage ratio equals \frac text total household debt text disposable personal income \. This measurement reflects the financial strain on consumers and can signal trends in the economy. 6. Interest coverage ratio. This ratio indicates how easily a company can pay interest on outstanding debt and is typically expressed as \text interest coverage ratio equals \frac text operating income \text interest expenses \. A ratio of 3.0 or higher is generally considered healthy, suggesting strong earning stability. What does leverage mean in finance? In a financial context, leverage refers to the practice of using borrowed funds to invest. The main goal is to generate an overall return greater than the interest expense of the debt. While leverage amplifies both returns and losses, it remains a vital strategy in capital investment. How is leverage ratio calculated? Calculating leverage ratios varies by type, generally involving a division of a company's debt by another measure like equity, total capital, or income metrics. Each ratio gives a unique perspective on financial health and risk. What is a good leverage ratio? Determining a good leverage ratio is context-dependent. It hinges significantly on the specific industry and company operations. Capital-intensive sectors often carry higher leverage levels compared to service-based firms. Therefore, assessing ratios relative to industry standards and historical performance is crucial. Conclusion. Leverage ratios serve as indispensable tools in financial analysis, providing a clear lens through which to evaluate how reliant a company or individual is on debt to fund operations. While leveraging debt can yield higher returns, excessive debt may lead to financial distress and default. Understanding the dynamics of leverage ratios, including their calculations and implications, equips financial professionals, investors, and policymakers with the ability to make sound financial decisions. As conditions evolve, staying informed about leverage ratios and their regulatory landscape will remain pivotal in fostering sustainable economic growth.